Most beginners who want to grow their money eventually face one big question. Should I start investing or should I try trading? At first glance, trading looks exciting. Fast profits, quick wins, and constant action. You see people online showing big gains, talking about daily trades, and making it seem like money can be made instantly. Investing, on the other hand, seems slower, less exciting, almost boring. And because of that, many beginners feel drawn toward trading first. But here's the truth. Choosing the wrong path early can cost you time, money, and confidence. It can even push you away from building wealth altogether. So in this video, we're going to break down investing versus trading in the simplest way possible so you can clearly understand which one is better for beginners and why. Let's start with investing. Investing is the process of putting your money into assets like stocks, index funds, or ETFs and holding them for a long period of time. We're not talking about days or weeks, we're talking about years, sometimes decades. The goal of investing is not quick profit, it's long-term wealth building. When you invest, you're allowing your money to grow over time through three main factors: market growth, dividends, and compound interest. Market growth happens as companies expand, generate profits, and increase in value over time. Dividends are payments some companies give to shareholders as a reward for investing. And compound interest is where the real magic happens. Compound interest means your money earns returns, and then those returns begin earning returns themselves. This creates a snowball effect. At first, the growth seems slow, almost unnoticeable, but over time it accelerates, and eventually it becomes powerful. This is why investing is often described as boring in the short term, but extremely rewarding in the long term. Now let's talk about trading. Trading is a completely different approach. Instead of holding assets for years, traders buy and sell frequently to take advantage of short-term price movements. This can happen within minutes, hours, or days. Some traders focus on daily movements, others hold positions for a few days or weeks. But the goal is always the same: buy low, sell high, and repeat the process as often as possible. At first, this sounds simple, but in reality, it's much more complex. Trading requires technical knowledge. You need to understand charts, patterns, trends, and indicators. It requires timing. You need to know when to enter and when to exit. It requires discipline. You need to stick to your strategy even when emotions are high. And most importantly, it requires emotional control. Because markets move quickly, and when money's on the line, emotions can take over. This is where many beginners struggle, because trading is not just about making decisions, it's about making the right decisions under pressure, and that's not easy. Now let's clearly compare investing and trading so you can see the difference. Investing is long-term, trading is short-term. Investing focuses on time in the market, trading focuses on timing the market. Investing is more passive, trading is highly active. Investing is generally lower stress. Trading is often high stress. Investing builds wealth gradually. Trading attempts to generate faster profits. And here's the key point. Timing the market is extremely difficult. Even professional traders with years of experience struggle to do it consistently. That's why most beginners who try trading end up losing money. Let's talk about why that happens. One of the biggest reasons is emotional decision-making. When the market goes up quickly, beginners feel excited. They jump in, afraid of missing out, but often they're entering at the peak. Then the market drops, and instead of staying calm, they panic. They sell at a loss, and this cycle repeats. Another issue is over-trading. Many beginners believe that making more trades will increase their chances of profit, but in reality, more trades often lead to more mistakes. Each trade carries risk, and without experience, those risks add up quickly. There's also the influence of social media. People see others posting big wins. They follow tips without understanding the strategy behind them. By the time they enter a trade, the opportunity is already often gone. And finally, there's the issue of unrealistic expectations. Many beginners expect fast results. They want quick profits. But when reality doesn't match those expectations, frustration sets in. This leads to poor decisions. Now let's look at why investing works better for most beginners. First, investing removes the need for constant decision-making. You don't need to predict short-term market movements. You don't need to react to daily news. Instead, you follow a long-term plan. Second, investing takes advantage of how markets behave over time. Historically, the stock market has gone through ups and downs, but over long periods, it has trended upward. This means that long-term investors benefit from overall market growth. Third, investing allows for diversification. Instead of putting all your money into one stock, you can spread it across many companies. This reduces risk and creates more stable growth. One of the easiest ways to do this is through index funds. Index funds track entire markets. For example, an index fund might track hundreds of companies at once. This means you're not relying on one company to succeed. You're investing in the broader economy. Another major advantage of investing is emotional stability. When you're investing for the long term, daily market movements don't matter as much. You're not reacting to every rise or fall. You're focused on where your investments will be in the future. This makes investing much less stressful than trading. Let's also talk about time commitment. Trading often requires hours of attention. You need to monitor charts, follow news, and make quick decisions. Investing requires very little time. You can set up automatic contributions, check your portfolio occasionally, and stay focused on your long-term goals. For someone with a job, family, or other responsibilities, investing is far more practical. Now, if I were starting from scratch today, what would I do? I would focus entirely on investing. First, I would build a strong financial foundation. That means paying off high-interest debt and building an emergency fund. This gives you stability and prevents you from needing to sell investments during tough times. Next, I would open a simple investment account. Nothing complicated, just a low-fee platform that allows me to invest consistently. Then I would start investing in broad market index funds. I would keep my strategy simple, diversified, and focused on long-term growth. After that, I would use dollar-cost averaging. This means investing a fixed amount every month, no matter what the market is doing. This removes emotion and builds discipline. Over time, this approach smooths out market fluctuations and reduces the risk of poor timing. Finally, I would stay consistent. I wouldn't try to predict the market. I wouldn't chase trends. I wouldn't panic during downturns. I would stay invested and let time do the work. Now, can you do both investing and trading? Yes, but with caution. A common strategy is to keep most of your money in long-term investments and only use a small portion for trading. This allows you to learn trading without risking your financial foundation. But it's important to treat trading as a skill that takes time to develop, not as a shortcut to wealth. Let's talk about expectations. Investing is not a get-rich-quick strategy. It takes time, it requires patience, but over the long term, it can be incredibly powerful. The longer you stay invested, the more compound interest works in your favor. And this is where real wealth is built, not through quick wins, but through consistent growth over time. So when it comes to investing versus trading, which is better for beginners? For most people, investing is the clear winner. It's simpler, it's more reliable, it's less stressful, and it aligns with long-term financial goals. Trading is not impossible, but it requires experience, discipline, and emotional control that most beginners haven't developed yet. So the smartest approach is to start with investing. Build your foundation, gain confidence, learn how markets work, and once you have that foundation, you can explore other strategies if you choose. But always protect your core investments, because those are what will build your long-term wealth. At the end of the day, the goal isn't to make fast money. The goal is to build financial freedom. And financial freedom comes from consistency, from patience, from making smart decisions over time. So start simple, stay consistent, and let your money grow. Because the earlier you start, the more powerful your results can become. And the longer you stay committed, the closer you get to financial independence.